For some insights into the big picture for the market and stocks and ETFs to consider for your portfolio, I want to welcome in our next guest, Eddy Gifford, a CFP and wealth advisor of Tactive. Eddy, so great to have you on our show this afternoon, and of course, Happy New Year. Before we get to your picks, though, I want to start out with broad market. We've had kind of a coin toss start to the year. Some would call it bumpy. Yesterday, we started out lower with kind of a continuation of what we saw and what would normally be a Santa Claus rally. What's your takeaway on this flip-flop start to the year?
Well, we kind of anticipated that we would at least have a little bit of a breather, just from the standpoint that the market's been straight up for 2 years. We've had over 20% per year for the last 2 years on the S&P 500. So we'd expect that at some point we would kind of consolidate a little bit. We would kind of breathe. We like the pullbacks. We don't like the corrections, right? We like it when it pulls back 10% or 5% and then we're off to new highs. We don't like it when it's a correction that goes down 20 plus or when that turns into a bear market. So we're not scared of it, but we have been kind of monitoring very, very closely throughout December and into January. And yeah, I think that you explained it well when you said it was kind of like it's been kind of like a coin toss type of year so far. Yesterday opened up down, opened up, finished down. Today is looking like a good day. And of course, we're only a couple days into the new year, so who knows what's going to happen. But I do think that there is a lot of confidence out there. But I also think that if you've been riding that wave for the last 2 years, there's not an issue with taking some profits and kind of maybe playing a little defense until a new trend emerges. We don't really have like the uptrend that we had 2 or 3 months ago in the broad markets. And so right now, I would say maybe take profits and diversify a little bit more. I do think that diversification is going to be the more advantageous strategy heading into the next year or two, whereas concentration has been the number one driver of performance the last couple years.
Are we due for a correction, though? Because you mentioned a correction, and you mentioned that many wouldn't like to see, obviously, a bear market. But are we due for a correction, and would that kind of just be normal given what we've seen with the market gains, especially they were significantly more than, or I should say, not necessarily significantly, but more than many expected for 2024?
Absolutely. I think we're totally due. Like, I think we could easily pull back 10, possibly 20%. It just kind of depends on how things shape up with the new administration. There's been a lot of promises. There's been a lot of things that they're going to try to do. And I do think that their intention is to implement. The problem is that with every implementation, there is change, and people don't like change. Markets don't like change. So that could be something that kind of causes things to kind of pull back at least briefly, build a new base, and then as we have like the plan going forward and we see the implementation working, that's when we're off to new highs all over again. And of course, when we have like these euphoric years like we've had the last couple years, and we start seeing like the risk appetites that we're seeing now, it's hard not to get a little bit cautious as a financial advisor, just because we know when everyone is all about it, that's when things usually sneak up on us. So we're just being mindful of that. But the wall of worry is there for a reason. We're going to ride it for as long as it continues to climb.
All right, and let's talk a little bit about your outlook, especially when it comes to the moves in the bond market. 10-year little change today, but what are the moves in the bond market telling you about the outlook for 2025?
See, that's the big one. That's the one that when we're looking at the big picture and we're saying, hey, like what's going to happen this next year? Well, the bond market is telling us that we're going to have a pretty significant correction, whereas the stock market is telling us all is good. And then you hear the Fed talk about inflation, you see the inflation prints, and you've seen those kind of creep up over the last couple of months. So you start worrying about inflation. But then on the other side, you look at China, who's heading into almost a deflationary environment. And so it's interesting now that we're dealing with a global economy, a global market, if you will, compared to like 20 years ago, where we were really only focusing on the United States. And so I do think, though, that the odds are more in favor of rates coming down throughout the year. I do think that the inflation, although it has been sticky, we are going to see that kind of subside throughout the year. And if that happens, then we would expect an ETF like TLT, for example, the 20-year bond, to potentially, especially if the market breathes and pulls back, potentially even outperform stocks this year in that scenario. Of course, if things just continue to run and there's still this little bit of fear about inflation, we would expect bonds to be flat and the market to kind of grind upward. We definitely don't expect another 20% year this year in the stock market, but I'm hoping that I'm wrong about that.
Yeah, that TLT seems like a contrarian pick here. But let's talk about some more of the picks on your list. One that wouldn't necessarily be a contrarian pick. I know you're looking at Marvell. It's up today. It had a strong year last year. Tell us about this pick for you.
Yeah, so Marvell, like obviously a very good year last year, and we're trying to kind of find, hey, like maybe not the new NVIDIA, but in the tech space, what chip makers have a lot of upside potential, and we really like Marvell from the standpoint of it primarily serves data centers, and when you think about the world and we think about AI, artificial intelligence, we can't have these AI improvements without these significant data centers. And then, when it comes to buying a car nowadays, I feel like the primary driver of the final decision tends to be technology, and so they're making the chips for a lot of these smart cars, and so I think that both of those trends will provide some wind at the back of Marvell. So we definitely like it, and it's been kind of running strong, and it's kind of like taking on some leadership compared to some of the other tech giants. So we're willing to jump in and ride the wave as long as it's going, for sure.
Yeah, riding that wave. It's up 4% today. Speaking of another wave, this one I know is on your list. It's having another big day today, but it's essentially a read-through to Bitcoin, and that's MicroStrategy. Tell us about your thesis on why it's on your list.
Yeah, well, MicroStrategy just had this like crazy run at the end of the year. We watched, it just go insane in November. And then Bitcoin kind of stabilized and normalized and has remained relatively flat throughout December, while MicroStrategy had come down nearly 50%. And it was, we felt like it was kind of like it was oversold. And we also feel like if Bitcoin does run, a lot of people are saying that Bitcoin is going to double this year just based on the 4-year cycle. And if that ends up happening, we'll probably see MicroStrategy go, 2x or 3x in that scenario. So, definitely not for the faint of heart. I mean, we have, I think it's up like 13 to 15% today, and there's days where it's down 13 to 15%. So the volatility can really like mess with you, especially if you're looking at your account every single day. But we think a small piece, 1 to maybe 5% of the portfolio for the most aggressive investors, it can help you out a lot. It's not going to hurt you too much if you stay disciplined.
All right, and then tell us about the last pick on your list. You call this hedge pick. What's the view here? Simply Managed Futures, it's a strategy ETF. Tell us about this one.
Yeah, so the biggest thing when I'm building a portfolio is that obviously I want to lean into the trends, but I also want to be cognizant of the fact that the trend can change and things could go in the opposite direction. As I already mentioned, I think that we could see a good year in stocks, albeit we'll probably have a pullback. And then I think that we could see a good year in bonds just because they're so beat up right now. But in the event that we see like a resurgence of what happened in 2022, where inflation starts to creep up and that crushes both the stock market and the bond market, we want to have something in the portfolio to insulate that. And managed futures in general do very, very well in inflationary times. And even if we look at managed futures in 2022 as a proxy, it's one of the few asset classes that was actually up compared to everything else that was down. So I mean, I'm okay with it being red for the next year if the other two places are green. So part of just building that portfolio is making sure we have a little bit of everything in there that offsets each other, because we don't know when the trend is going to change. We don't know when the moves are going to happen, but we want to insulate so that when we can identify the new trend, we can lean into that one.
So that's your insulation pick. But I think my takeaway, especially when you mentioned Marvell earlier, is who isn't trying to find the next NVIDIA. Eddy with picks, Eddy Gifford with picks when it comes to the contrarian picks or the tech pick. You've got it all. Eddy Gifford, CFP, and wealth advisor Tactive. Thank you so much today for joining us, Eddy.
Yes, thank you for having me.